International Paper IP is one dividend stock down 45% that you might regret not buying on this dip. Now in this video, I'm going to talk about why I think that's the case. So I'm going to justify my reasoning with some financial figures from International Paper to justify why I think you might regret not buying this dividend stock on the dip. So let's begin. Starting with International Paper's dividend yield of 5.17%. This is a healthy dividend yield. And if you compare this to the 10-year government bond, trading around 3.4% as of this recording, you're getting a bigger dividend yield with International Paper. You're also getting the potential for dividend increases in the future. Also, keep in mind that with a stock compared with the government bond, the stock is more risky than the government bond. So you're getting the dividend yield, sure. You're also getting the potential for a dividend increase, yes, but you're also getting the potential for a dividend decrease, right? That's also possible. And when you're investing in a dividend stock, you get returns on two fronts. You get the dividend yield and you get a capital gains return, which is not always positive, right? You're buying the stock and the stock price will fluctuate and it will not always move higher. So dividend stocks are more risky than government bonds, but they offer you the potential for greater returns compared to government bonds. The next thing I wanted to show you is International Paper's annual revenue going back a decade. Now its revenue is down from the peak of just over 22 billion down to 21.16 billion, but it has been moving higher, and the company has instituted price increases, which is helping boost revenue higher from here. The company increased prices when inflation was soaring a couple of quarters ago. But now one of the benefits that International Paper is capturing is lower energy costs and lower input costs because inflation pressures have eased. Meanwhile, the company still has its price increases implemented and they're not going to remove those price increases. So this should help International Paper increase revenue. But also, let me show you the next slide here. Here is International Paper's operating profit margin over the trailing 12 months. This had come down as a result of higher input costs as inflation soared. But now, like I mentioned earlier, International Paper reacted to those higher costs by raising prices, and at the same time, inflation has eased, especially energy and commodity prices, and so that's creating lower prices for International Paper, and it expects this uh, two-sided expansion in its operating profit margin. You see, it's already moved higher from the lows up to 8.29%. I suspect this will edge incrementally higher throughout 2023 as the price increases along with easing inflation work to boost International Paper's operating profit margin. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And the final reason I'm going to give for why you might regret not buying this dividend stock on the dip is its attractive valuation. International Paper is trading at a forward price to earnings ratio of 12.25. That's near the lowest it has traded for going back about 15 months. And since the prospects for earnings are solid for the rest of this year and perhaps going forward, I think this is a good valuation for dividend stock investors to buy International Paper stock. All right, so that's all I've got for this video and why I think you might regret not buying this dividend stock on the dip. I hope you've enjoyed this and I hope you'll come back again next time to see me for another video. Thank you so much for watching.